Tesla dropped 14.5% in a single session. That's $215 billion in market cap. Gone. In one day. And here's what makes this interesting. The revenue numbers were actually strong. Sales up 26% year over year. More cars delivered than any quarter before it. So why did the stock get crushed? Because the market changed the rules. And if you don't understand what changed and why, you're going to misread the next earnings drop too. Today, we're going to break down exactly what happened in Tesla's Q2 results and what the data was already telling us before any of this happened. Let's start with Tesla's Q2 2026 earnings, reported July 22nd, because the gap between the headline and the reality is the whole story here. Revenue, $28.2 billion, beat expectations, up 26% year over year. Strong. But then you go one layer deeper into the Q2 numbers. Earnings per share, 33 cents. The market expected 51 cents, a 35% miss. Gross margin, 16.8%, expected 19.4%. Operating margin, 1.4%, expected 5.4%. And the Q2 number that really spooked investors, free cash flow went negative. Minus $1.09 billion for the first time in 2 years. So, what you have is a company that grew its top line 26% while profitability collapsed at almost every level. Revenue goes up, but the amount Tesla actually keeps from each dollar sold went down. Why? Capital expenditures jumped 142% year over year, nearly $6 billion in a single quarter on Robotaxis' Optimus AI infrastructure. On the earnings call, Musk called it a massive spending year. Now, here's the thing. When you look at Tesla's fundamentals through Invyra's valuation models, the fair value came in at $267.38 against a market price that has now fallen to $313. That's still 17% overvalued. And that fair value calculation was done on July 16th, a full week before these earnings even dropped. The fundamental weakness wasn't a surprise. The market just finally started pricing it in, and it isn't done yet. And this wasn't just Tesla. Look at what happened across earnings this week. Google's parent beat every single estimate. Revenue up 27%, cloud up 82%. The stock fell almost 7%. Texas Instruments beat on both revenue and EPS. Margins expanded. Still fell 3%. Then, after the bell, Intel, written off 2 years ago. Revenue up 25%, profits double what was expected. AI data center up 59%, jumped 11%. The pattern. The market isn't rewarding beats anymore. It's rewarding proof that spending converts into results. Intel showed receipts. Tesla handed out another IOU. And this gets to the core issue. It's not just about one bad quarter. When you look at Tesla's ROIC, return on invested capital, it's running at 4.3%. The cost of capital is 13.2%. The gap means every dollar Tesla is pouring into the future is, right now, destroying shareholder value, not creating it. That's the number that matters more than the revenue beat, and it's the number the market finally started paying attention to. Here's where it gets nuanced, because after a drop like this, two very different temptations appear. The first is panic. The second is assuming it's automatically cheap now. Neither is right. As of this morning, Tesla has now fallen 3 days in a row. According to Invyra's cadence data, a 3-day consecutive down streak like this is unusual. It only happens about 10% of the time. The selling pressure isn't random noise anymore. It's sustained. And yet, here's the tension. Technically, this stock is in extreme oversold territory. RSI has dropped all the way to 15.7. That's not just oversold. A reading that low is rare. It tells you the short-term selling has been intense and fast, but oversold doesn't mean the bottom is in. Let's think about what the market is actually pricing in. Analysts expect Tesla's earnings per share to grow from $1.81 this year to $9.06 by 2030. That's the story the stock is built on. And even after 3 days of selling, Tesla is still pricing in a very ambitious future. Still 17% above Invyra's fair value. For that future to materialize, one thing above everything else has to change. ROIC has to recover. At 4.3% versus a cost of capital of 13.2%, Tesla needs to start generating real returns on the billions it's investing. That's what Q3 and Q4 earnings need to show. So what are the signposts to actually watch? First, margin recovery. Gross margin climbing back toward 20% signals the unit economics are improving, not just the delivery volumes. Second, free cash flow turning positive again. One negative quarter can be forgiven. 2, starts to look like a trend. Third, on the prism signal, the readers still hold with low conviction. Direction and quality are both bearish. Momentum and timing are flashing bullish from these extreme oversold levels, but that alone isn't alignment. What you're waiting for is direction and quality turning, not just a technical bounce. RSI at 15.7 might spark one, but a bounce isn't the same as a recovery in fundamentals. Tesla's story isn't over, but right now, the market isn't paying for the story anymore. It's waiting for the proof. So what do we actually take from all of this? 1. Revenue growth is not the signal. Tesla beat on revenue and fell 14.5% the same day. Always look at what's happening below the headline. Margins, free cash flow, earnings quality. 2. ROIC below WACC is the real warning. When a company earns 4.3% on capital that costs 13.2%, aggressive investment makes the problem worse. Watch this on every capital-heavy growth stock. 3. A big drop doesn't equal a bargain. Cheaper is not the same as cheap. Whether a stock is undervalued depends on what it's actually worth, not how far it's fallen. 4. When signals conflict, patience is a position. There's no edge in forcing a trade when the data isn't aligned. If you want to run this kind of analysis on any stock, fair value, ROIC versus cost of capital, technical and fundamental confluence, Invyra has all of it in free right now at invyra.thinkrium.ai. Link is in the description. Subscribe if this was useful. We do this kind of breakdown regularly. No hype, just the numbers. See you in the next one.